U.S. bank stocks are in a state of turmoil as investors face growing concerns over mounting risks. The sector has been shaken by its exposure to recent auto bankruptcies, and the repercussions are being felt across the board. The shaky foundation of credit quality, Zions Bancorporation, a prominent player in the industry, has alleged fraud and taken a $50 million charge on 2 commercial loans. This revelation sent shockwaves through the market, with Zions stock plummeting by 12%. Western Alliance, another regional bank, has also filed a lawsuit against a borrower, alleging fraud and a breach of a business loan agreement. Their stock took a hit, dropping almost 11%. The impact of these events extends beyond individual banks. The U.S. Regional Banking Index witnessed a significant drop of nearly 4%, indicating a broader sense of unease among investors. A web of unanswered questions. Jefferies, an investment bank, held an investor day on Thursday, but the event left many questions unanswered. The firm's exposure to the bankrupt auto parts maker First Brands has raised concerns. Its stock has taken a substantial hit, falling by over 20% since the bankruptcy announcement. Analysts are divided on the matter. Some, like Stephen Bigger from Argus Research, highlight the importance of credit quality and the potential for one bank's poor performance to drag down the entire group. Others, like Sean Dunlop from Morningstar Research, suggest that investors are selling Jefferies stock first and asking questions later, a move that may be overdone. The parallels drawn between Zions' disclosure and the collapse of First Brands have sparked further debate. Wall Street analysts point to the exposure of major lenders and the need for transparency in the credit market. As global lenders file unsecured claims, the issue becomes a test of management and oversight in the rapidly expanding private credit sector. A cautionary tale. The recent sell-off of bank stocks serves as a reminder of the 2023 failure of Silicon Valley Bank. High interest rates and paper losses on bonds led to a fatal deposit run. Highlighting the fragility of the system, the bankruptcies of First Brands and Tricolor have brought attention to the risk controls within banks and the opaque nature of the credit market. Complex loans and new facilities make it challenging to assess exposure accurately. Some analysts view these collapses as isolated incidents tied to specific borrowers, but the cases have undoubtedly fueled a sense of unease. As Mike Mayo, a banking analyst at Wells Fargo, puts it, in times of loose credit, fraud instances increase. Right now, credit is generally fine, but recent issues require heightened vigilance. The situation remains fluid, and investors are watching closely as the implications unfold. With the upcoming quarterly results announcements, banks will need to provide clarity and reassurance to regain investor confidence.